Hi, my name is John Hollmann. This session is Complexity, Moving Beyond Talk. Little introduction to myself. I'm the owner of Validation Estimating for the last 15 years. Got a wide variety of experience in contractor and owner companies, including 7 years in benchmarking with a company called Independent Project Analysis. Worked in a variety of industries with a focus on estimating, risk quantification, and project controls. I've been very active in AACE International, both as a director, a technical board, as well as helping develop certifications, and many of the recommended practices, some of them which we'll be discussing in this meeting or this session today. What you're about to see in coming slides is taken from my book titled Project Risk Quantification. It's available in a Kindle version if you want to follow up on that. But if you do, the complexity topic is covered in chapter 14 of the book, and it covers some of the material I have here today. There's also a paper available if you're an AZ member from the 2015 Cost Engineering Journal on the same topic. I titled the show Moving Beyond the Talk because many of us are very familiar with the topic of complexity, reading about it in journals or seeing presentations, most of it fairly theoretical or qualitative in nature of some of the causes of it, the nature of complexity and so forth. But what has been missing is practical ways for the average person to measure complexity on their project, and then to use that measure to quantify it in terms of cost and schedule for their day-to-day projects. Methods such as systems dynamics have the potential for doing nonlinear modeling, but really not proven practical for the average cost engineer or risk analyst. One thing we do know about these complex projects, including mega projects, is that their cost growth distribution has a fat tail and a high side. Some would call this a nonlinear behavior, but in more practical terms, we're talking about blowouts of cost and sometimes schedule. And our traditional risk analysis are failing to predict these potential blowouts. Without measures and quantification to clearly show to management how complexity is driving these failures, management's not likely to take any significant action to manage it. And I have the phrase in here, show me the money, meaning that if you just tell them to do something, they're probably not going to pay attention unless you can tell them what it's going to cost them. So borrowing from theory or talk, if you will, I'm going to end up and share with you a practical way to measure complexity and analyze its impact in a way that we can warn management that a potential failure is coming. And maybe they can step away from the tipping point, step away from crossing into chaos or a blowout. First, let's look at a little background on the nature of cost overruns for complex projects. What you're looking at on this slide is a study I did in 2012. It was a meta-analysis of about a dozen published research articles on cost overruns for large projects. This is not necessarily mega or complex, but just large. And what I found in that study, and what you see on the graph, is the blue curve is the distribution being reported in these studies. And the takeaway is that the P90, or the high end of the tail, is 2 to 3 times what we are estimating. And what we are estimating is in the red distribution curve, which has maybe a plus 30, minus 10 range on it, where in actuality the range is something more like plus 50, 60, or 70%, and a minus 10%. The literature, as you know, is replete with examples of blowouts and major overruns, and I'm not going to repeat them here because we've seen them so often again and again. But it seems that our inability to foresee these blowouts and to control costs has led some to blame it on what was called strategic misrepresentation or lying, particularly Dr. Bent Flibberg. But more recently, this thinking has largely been debunked as not being supported by the research that's out there, at least not showing what practices might actually drive these overruns. We know from research we don't need these kind of theories to explain what's happening. What we do know is that complex projects are fragile. And to quote Ed Merrow of IPA, his statement was they don't tend to simply degrade toward poor outcomes, they tend to collapse. In my terms, that would be crossing a tipping point to a blowout. So rather than just listing a whole bunch of blowouts that are reported in the journals, I thought I'd show you a little case study of a mega project that blew out. This was, I don't want to get specific about it, but in the last 10 years or so. And what you'll see in the outcome is that the chart on the right is the construction hours per period over the x-axis, which is the years of the project. The dark line is the planned manpower loading. The dashed line is something like the actual manpower loading, and what you can see from this is that the workforce was roughly about double the planned peak, and the duration of the project was starting to approach double the planned duration. So the area under that curve, which is the labor man hours or labor cost, you can see is pretty much a huge blowout. But I wanted to show you in this case study, I looked into what were the characteristics of this project. What risks did it have that might explain what we're seeing here? Well, first of all, it was very large. It was a mega project. It was in the billions of dollars, and they were doubling a large plant, doubling its capacity. And the scope of the project, physically, the complexity was very high. They were working on nearly every process unit and utility unit in the plant in order to accommodate the increased capacity. In terms of the execution strategy, very large EPCM, of course, with many contractors from local and international. And they were working in a region that was not in their core experience area. Then another set of attributes about the project are the nature of its project system. First, it had a poorly defined scope. I'm not saying terrible, but it certainly wasn't optimally defined as we would expect from best practice. The owner did not have experience in this type of project, but maybe worse is the contractor didn't bring the A-team to this project. It was a very busy time, and so essentially they had the proverbial B team. And then that B team was not applying the best planning and control practices. And then finally, as things started to not go so well, indecisiveness started to crop up and arguments and disputes, so that changes that were occurring and trends and so forth were not dispositioned and taken care of in a timely way. All of these were elements, as we see, of things that tend to push projects over that tipping point. Finally, there were external risks from the market in that there were skilled labor shortages. This project was taking place during what we call the super cycle, when there were many enormous commodity projects around the world that were taking up many of the resources of the major EPC companies. So to summarize those attributes we just saw, there are three elements that are going to be carried forward in this presentation that will be part of a complexity measure, if you will. The first one is the complexity itself, and that includes elements of complication, which is the sheer number of work breakdown elements, or the sheer size, as well as the complexity in that the contractors working on the site and the physical connectiveness of the plant is very complex in that there were a lot of interactions of everything that had to work together. So that's the first element. The second element is it had a weak project system. It had weaknesses in leadership, decision making, team development, the general capabilities of the team, and the planning and control practices, and it was in a challenging culture that didn't have a lot of work going on of this nature. All of this was despite the EPCM contractor being a major player, but like I said, it was a busy time. Finally, in terms of risk events or stressors on the system, as I mentioned, this was part of the taking place during the commodity supercycle. So that was pressuring everything, the weak system and the complexity. These elements we just went through will be the focus of a complexity measure we're going to talk about going forward. Now, in addition, I wanted to mention what does a blowout look like that a failure just as like the one we looked at? What is the symptom of it? And what I found from my experience of benchmarking and consulting over the last 25 years is that the probability of a blowout type failure is probably about 1 in 7 if you have many of the attributes we just saw of a weak system and external stress and so forth. These are not the norm. So one takeaway from this is we don't expect a blowout, but they're not black swans. One of the problems with these fairly low probability of 1 in 5 or 1 in 10 is that the project managers on these projects may, in their career, have never experienced a blowout if they've only been on 2 or 3 mega projects. So it's very hard to convince them that this is even a possibility. When you describe a doubling of labor or a blowout like this, a lot of project managers just have a hard time conceptualizing how bad these things can get. But they are very real, and I've seen plenty of them in my day here. So in terms of the impact, the rule of thumb is that when these things go bad and you lose control, generally speaking, there is roughly a doubling of the labor-related costs, and this would include some of the engineering, detailed engineering, but also going through fabrication and construction labor and the indirects associated with that. If you assume that those costs are roughly 50% of the total, then if you had a $1 billion project that had a failure like this that crossed the tipping point, it would come in at $1.5 billion or maybe as bad as $2 billion or more. So when you see these blowouts again and again, they have that same nature of when you lose control, you do get them finished eventually, but it takes an awful lot of labor and workforce to get these things done. So for the rest of the presentation, I'm going to describe these inputs and put them in the form of a measurement called a tipping point factor, and then show you how to use that tipping point factor to quantify the risk in a fairly practical and simple model. So let's do a little bit of talking. I said we're moving beyond the talk, but let's talk about some of the theory behind what I'm talking about here, just to make sure we have a good grounding. So when you look into complexity, most folks that start studying the topic are going to follow the same kind of path of inquiry as I did. They're going to read about systems dynamics, chaos theory, complex system theory, and scores and scores of articles and presentations on the topic. And so there's fairly good understanding of what it is and how systems behave in the presence of complexity, but in general, it's not been brought down to earth, where folks like ourselves can put it into practice. So I'm going to just briefly touch on these topics and try to explain how the theory can be put into a practical sense. First of all, we need to recognize that a project is a system, or if you're an owner company, your project system is how you manage projects, the organization you have and the resources that are brought to bear, the tools, the software, all of that. So in some respects, what we're talking about here is part of the world of systems engineering. And in that world, they have a methodology called systems dynamics that can be used to model a complex system and how it behaves over time. And for the last 20, 30 years, there's been many examples and studies of systems dynamic models applied to projects. A lot of them are used to explain claim situations, but the difficulty is that they have to be uniquely set up each time. It takes a high level of skill and experience to do so, plus quite a bit of money, and very few projects are going to take that time to study the project ahead of time. So they're just simply too difficult to use ahead of time. However, we want to be able to have a model that can predict the types of disorder and nonlinear behavior that systems dynamics is able to show. So, I mentioned nonlinear behavior. So when we talk about that, that takes us to chaos theory. I don't understand the math that well. I'm not a mathematician or an expert in the field. But in general, chaos is a state of disorder. It's an unpredictable system. It's essentially, in our terms, out of control. And the behavior of it, in terms of it, the cost results and the durations are nonlinear. What that means is that the labor workforce, for example, is putting in hours, but they're not getting much from it. And so what we saw in the previous example is that the labor workforce doubled, but their productivity was only about half of what you would hope or expect on a project. So it's nonlinear in that you keep putting more and more hours in and getting seemingly less and less progress at the end of the day. So in chaos theory, what we're looking at is, when do we cross from an orderly project that's under control into a disorderly one that's lost control, and that's what I'm calling a tipping point. If we knew the attributes of a project that's approaching the tipping point, that would give us the start of a measurement and risk quantification method. The third theoretical background we need to have is about complex systems theory. It's a key focus of both systems and chaos research. Very hot topic, lots of papers on the topic. But the complexity focuses on the interactions of the system parts, as opposed to just the number of parts or the size. Complication is not synonymous with complexity, but it's part of it. But complex systems are more likely to be disorderly or nonlinear. Not necessarily, they're not always like that. Like I said, only 1 in 5 or 1 in 10 projects with a weak system may cross over into disorder, but they are more likely to. Then aggravating the complexity are stresses that are put on the system, such as a major risk event or many risk events that are impacting the project and taking team resources and so forth. But they're not going to help the situation, and they're going to compound it. But the good news of all this is that we can measure complexity. There's been so much research available that it's fairly easy to summarize it and wrap it up into a measure that we can use. Now this slide, I'm just showing a little bit more about the edge of chaos. I'm not sure how good of a diagram it is, but we see the workforce or the laborer being confused and pushed and overworked by the complexity. They're not making much progress. The plan is not what it should be, so they seem to be doing a lot of rework. And then we have external stresses from risk events hitting them, and then eventually probably going to lose motivation and cross over the edge of chaos. And then usually there's so much uncertainty on where things stand that it's just kind of like a fog on this whole thing, and everybody seems a little lost. Okay, now we got the background of systems dynamics, complexity theory, and so forth. This is a diagram that I extracted from a number of papers. This little tree shows the elements of complexity, and it breaks it down into various elements, such as the top one says differentiation, number of elements. That's really the size or the number of work breakdown elements in our project. The second one is the interdependencies between these elements. Things like joint ventures, partnerships, alliances, all of those create more and more interdependencies. But then we have these other topics that carry us down through team building, organizational structure, and so forth. All of these, if we can measure those attributes, we have the building blocks of a complexity measure. Now, we talked about stressors that put stress on the system. And this little tree breaks down some of the more common ones. We have at the top, we have time pressure. We know from IPA, Mr. Ed Merrow has always said that speed kills on mega projects. If you try to go too fast, you're probably going to break the fragile project. So that would put stress on a project. We've underestimated the work. Everybody's always going to be under the gun for having overruns. And so forth as we go through here. And at the bottom, we have the risk events themselves. If we have a strike or major delays, major storms and weather problems, all of those are going to put stress on an otherwise fragile and weak system. Now, we showed a whole bunch of things on the right of those slides, different things we can measure like team development and so forth. But the very, very good news is that there are recommended practices for risk quantification that actually measure everything that I just showed you on the previous two slides. So at AEC International, we have recommended practices that deal with systemic risks, which are attributes of the project system, such as the state of team development. We have project-specific risks, which are primarily risk events that occur and impact the project. We have external risks such as escalation, which measures the variations in the economy that the project's working within. And then AEC has also defined quantification practices for these risks. So for systemic risks, we have parametric modeling. For project-specific risks, we might use expected value method with monte-carlo, or maybe the CPM-based, risk-driven CPM-based method for the risk event. And then there's also probabilistic methods for escalation. All of those have been documented, are in practice in industry. So we can leverage this to give us a metric for measuring complexity, and then using these tools that are in the recommended practice to quantify it in a nonlinear way. So here's a chart pulling it all together. We have the complexity drivers and the stress creators shown in the blue. Those are all the various elements. And on the right in red, those are the AEC recommended practices that talk about those topics: how to rate them, how to measure them, how to quantify them. So we already have all of the things we need and the building blocks to come up with a quantification method, as well as measurement of the tipping point. So let's get into this. I keep mentioning the tipping point and measuring complexity and measuring tipping point. The next few slides will talk about that. So the tipping point metric, from an AEC recommended practice compliant view or approach, is first of all, I've identified the hypothesized causes of this nonlinear outcomes, and those are complexity and stressors. I explained that AEC recommended practices has methods that both rate and measure these things, as well as quantify them from a linear perspective. I would ask folks to maybe go back to the 2019 Risk Awareness Week, where I presented on the methods I just reviewed. We don't have time here to get into things like expected value, parametric modeling, but those were covered in last year's presentation. Or if you're interested, you can get the book. All of it is covered in the project risk quantification book. So the next step is to add a complexity measure and risk quantification functionality to what we have already. You look at the previous slide, these elements on the right, these are a summarization of those various attributes of a complex project that we talked about at the beginning. And came up with a scoring mechanism. And give you an example. On this stoplight diagram, you'll see size, decisiveness, team development, aggressiveness, and complexity rated. For size, we may give it a score of 3 on a scale of 1 to 3 if the project's over 1 billion or the field workforce is 1,000 or 1,500 people or more. That would be a red indicator. Looking at the risk events, which is the second row, we might have a threshold such as if the expected value of the risk events is greater than 10% of the base estimate, that would be red. You know, there's a little play on how we develop the thresholds, but this gives us a somewhat reliable and repeatable metric to give a warning to management that things are getting on the dicey edge. Why do we need this? Why do we have this stoplight diagram? As well, I don't want to jump into numbers right away. I want to talk to management, need to explain to them what this is saying, because management tends to focus on contingency, which for the risk analyst out there tends to be the P50 or the mean of our distribution. The problem is that the contingency, even on the most complex projects, is probably going to be reasonable, meaning that it's 25%, 30% in the worst case, and that percentage is not going to change the investment decision. We need to steer them to the fact that this project we're looking at with these red indicators is starting to approach that tipping point. And even though the contingency is acceptable or reasonable, there's a 1 in 5 or 1 in 10 chance that this project's going to be a blowout. It can be a career destroyer, and it will just devastate the company's return on capital for that year at least, and probably lead to major write-downs of hundreds of millions, if not billions of dollars. So we need to kind of wake them up, and that's what the intention of this is. Our goal is not to scare them, but sometimes they have to have a wake-up call. Now, once they're woken up, we have to give them some risk treatments of how to deal with it. So this table talks about some ways they can back off the edge of chaos. If their schedule is extraordinarily aggressive, it's a fairly simple matter usually once you get agreement from the business to slow down, give a little more cushion on the schedule. We can build the team a little better, take some more time to do better definition and so forth. So all of these are risk treatments we can take to get that red back to yellow or hopefully even green. So we have the tipping point measure. We got a warning, flashlight. But at the end of the day, people are going to say, the management will probably say, show me the number. What does this really mean? So we need to give them a quantification method. So what I've done is taken that measure we just talked about, which is quantitative, and build it into a factor that we can apply in the Monte-Carlo simulation we already have. So what we know about the complex project behavior so far is the probability of a blowout increases in proportion to the tipping point measure. We kind of know it's about a 1 in 5 to 1 in 10 chance of this happening if the tipping point factor is very high. And if it occurs, the typical result is roughly a doubling of the labor-related costs. So we have the elements of a quantification method. So all we have to do is build some functionality into the Monte Carlo such that a percentage of the iteration get hit or suffer a blowout, and the number of iterations that blow out, or the percentage of iterations, increases in proportion to the tipping point value or factor. And when it does blow out, the scale of that blowout is roughly a doubling of labor, but in Monte Carlo, we can put that in as a 3-point distribution, maybe even more than a doubling of labor. Now, I'm not going to get into the technology, but for those of you that want to play with your models, you can use the at-risk uniform function that can generate a random value between 0 and 1, and that if the tipping point percentage is less than that, the iteration will incur the blowout, which we've identified the cost with the distribution. It's not an exact science. Fairly simple method, though, that you can apply, and the tools you probably have. And what that does is when you run the simulation, you get charts like these. So we see on the top chart a example project where, half of those red symbols were red. Not all of them. We had a green or two and maybe some yellow. But what you can see is the tail, the fat tail, starting to grow on the right to the point where the P90 value is about 80% over the base estimate. Now, at that point, your net present value is probably going to be negative, and your IRR is probably not going to be meeting your threshold. But if we were to take some risk treatments and back off, so the second run, which has been scaled to the same x-axis, shows you a case where the tipping point metric was green and a few yellows and so forth, and we eased up on the aggressiveness and things like that. And what you can see now is that the P90 is not good, but it's not devastating. So that's the point of the quantification, is not to fund a contingency per se at these high values, but to drive the management to take risk. Now let's take that previous chart, skinny it down and scale it to the same axis as the chart I showed you at the very beginning of the research of actual project. And I think on the right there, you can see that the simulation and the blue curve of reality look pretty much alike. Now, I'm not saying that's a proof of this concept. It's still hypothetical. But it does demonstrate that with a fairly simple method, it's capable of generating the fat tail that we see in reality without making a lot of crazy assumptions and pushing things too far. Certainly don't have to bank on lying or misrepresentation. This is just the way projects behave in their fragile state. So you might want to go off and try this and apply this to your own methods and see if your method without such a mechanism can produce that blue curve. And if not, why not? And then apply the tipping point and see what you get from that. So using the quantification I just showed you, like I said, we're not going to use that to fund contingency. So what I do is I run the simulation with the tipping point turned off. So I have a toggle in the tool that disconnects that random generator and so forth. And I would recommend a contingency without this MPI. Then I would turn the toggle on and then run the model with the tipping point applied. That will tell us what the difference in the P50s is, and we may want to fund a reserve item for the potentiality of this type of outcome, depending on how much risk tolerance management has. But we also want to use the P90 from that second run in our net present value sensitivity, the wake-up call, to make sure the business recognizes the potential nasty behaviors that could result from this project if they don't take action. So that's pretty much wrapping it up. So with some takeaways I'd like to share with you is, first, complexity is not just theory for PhDs and academia. It's very easy to understand, and it can be measured. Further, the AAC recommended practices for some of our mundane practices actually measure them already, particularly the parametric modeling of systemic risk, which is an AAC recommended practice. The complexity or tipping point factor is well grounded in theory. So if anybody challenges your model and why are you coming up with these outcomes, you should be able to explain it. We know from benchmarking and research experience what failures look like, what the failure mode of mega projects and complex projects is. They are fragile, and the project failures increase in proportion to that tipping point factor, which covers complexity and stressors. And we also understand that the typical outcome is a doubling of labor-related costs plus schedule delays, which are part of that. We've covered a tipping point factor we can use as a warning, a kind of qualitative approach to get a discussion going with business. But we can also easily apply it in our Monte-Carlo simulation models to get a number. All of this will drive better risk mitigation, help us quantify reserves, and then finally we can use it in our decision making in net present value sensitivity analysis. So complex systems theory is evolving. Up to now, it seems like mostly talk and, like I said, academic speak, but it doesn't need to be. We have ways to move beyond the talk and to bring these theories into our practice in a practical way. So I hope you got something out of that. It's a very quick summary. Like I said, this is covered in my book, Project Risk Quantification. It's available at the link that's shown on this screen. And with that little tag at the end of the link, you get a event-only price for the book from the publisher. But it's also available in Kindle version for $9.99 via Amazon. So really no reason for anybody to go out and give it a read. So with that, I want to thank you. I hope at the presentation you were thinking of some questions and posted those. If you share them then or now, I think we'll be glad to come back later and answer any questions you might have. So thank you and have a good day.